Okay, welcome back everybody. So soon, one day later. Shout at me in the comments if for some reason the microphone doesn't work. It looks fine, so I'm assuming we're live. So, set up here. Yeah, welcome back everybody. Volatility Barometer episode 34 now. And we did one yesterday. I got a million questions about what types of trades to take. I said in the live stream yesterday we were going to push this back until Friday, maybe do one later in the week. And apparently not. Everybody's worried that they're not going to get their trades in. I tend to think there's really no hurry here. It's better to take your time and really digest what's going on. But I did hear a lot of frantic emails and people saying, hey, I'd like to get some action on the table. So here we go. We're going to talk about things. Of course, I'm going to put my own experience over top of this. I tend to be a little bit of a conservative investor. I don't mind taking risks, since in fact I can trade leveraged if I really see the good opportunity. But for the most part, I like to dial things back a little bit and let everybody know that you really don't have to attack these trades. So first thing we're going to do, of course, we're going to talk about the options trades that I think might play pretty well in this scenario. And we're going to do a short bias and a long bias, because there are ways to look at this trade where both are actually quite viable at this time, depending on the time frame, as we'll get into. And then we'll do the open Q&A. Typically that's the last thing we do, but because today is the Fed announcement, I actually suspect we might still be live going through the Fed announcement. So maybe 5 or 10 minutes before that's going to happen, we might pause and start talking about that real quick. There's really nothing that can be done. I'm not suggesting people actually trade the announcement, but we can watch it live. And I kind of suspect that there's going to be a lot of whipsaw, as there always is, right around that 2 o'clock time. So not much to be learned, but might be fun to watch it. So we will we'll get through all of that. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so welcome everybody, episode 34 here on the Volatility Barometer. Today is basically going to be all about options and the continuation of the VXX debacle that we have seen. So perhaps before we dive into the options, I should go through a little bit of an overview of some things to look out for, because this is not such an easy situation to be in. I know a lot of people during these times, sometimes they have a lot of conviction. They think in their head, I know exactly what's going to happen. And that's a pretty dangerous formula when you've got things moving around as quick as they are. So I want to slow things down a little bit and actually present a few things to look out for before we actually dive into these trades. So let's call these the rules of engagement. And these are pretty standard things that I like to remind people of whenever they're trading options. It's not just a matter of I have an idea and I'm going to go allocate capital. We actually have to think about a few things here. And of course, the first thing, know your product. You have to understand what you're trading You have to understand how it works. If it's a stock, it's probably a little bit easier. But if it is an ETF, ETP, like we're dealing with here, you really have to understand what it is. And so, of course, I did the really long live stream yesterday. If you basically knew everything that we were talking about, and you understand that the VXX trades against the VIX futures, and you're not tempted to think that it should somehow be tracking the VIX index. If you don't look at the S&P 500 to get signals on your VXX, maybe you're ready to do it. But there's a lot of people that were probably surprised by the breakdown that we went through yesterday because they really don't know what VXX is. So one thing that I would recommend if you are planning on trading these products, you're going to be doing this for probably, hopefully, if you're profitable and successful, you're going to be doing it for years. So why don't you just do yourself a favor, go ahead and reserve a weekend, set off a couple of hours, and just go ahead and read the prospectus, dive through a couple of my videos. You don't have to do the whole thing, but just a couple of the videos. The one that I always recommend people kind of start with because they really don't know what VX. Let me shut this guy up. The one thing, if you go to the YouTube channel, there's always that search function. And there's 200 videos on here now. So if you search something, chances are good I've done a video on it. But if you go to VIX Futures in this little search bar, the one that I think you should also watch is this one. It's VIX Futures Expiration. You really have to understand how this works. Of course, you can also do this one. We've done tons of VIX Futures stuff, you know, talking about backwardation, talking about contango. I've got tons of videos that could keep you really busy. But bottom line, go ahead and read the prospectus for these products, the VXX, the UVXY, skim through all the legal nonsense if you have to, but make sure you get that done. And also check out a few videos specific to the VIX Futures Complex. You really, really have to understand how that works if you're going to be trading these products long term. I don't want anybody to be surprised by any of these actions. Number two, this is something that I spend an awful lot of time talking about and reminding people. Never trade undefined risk. Now, never, I suppose, is a very strong word, but just as a baseline, let's just say never. I can always leave a little bit of room, a little bit of door open if you're trading on the other side of the danger zone. So, for example, volatility ETPs like VXX, of course, the danger is the high, it's the spike. Now, vol crush does happen as well, so you can lose money on the low side. But if you are selling short, naked put options on VXX, for example, it's not diabolical. I mean, you can lose a lot. You can lose your full premium, of course. You can lose a little bit more than you planned on. But it's not going to volpocalypse on you like that. So I'll leave a little bit of space open there. But in general, what people often forget is there's actually two reasons why you shouldn't trade naked options. And for anybody in the chat section, I'm looking at you guys who are selling naked calls on VXX and naked calls on UVXY. There's two reasons why you shouldn't do this. The first reason is probably what everybody tells you, is that eventually you could blow up. Some terrible event happens. There's a flash crash. There's a, God forbid, a terrorist attack. There's some type of cyber attack. That could happen, of course, and you're going to get caught and you're going to lose money. But the other thing that people often don't focus on, which is equally important reason never to sell naked calls, for example, is that it's just a very capital-intensive trade, and it's not going to be an efficient way to make money on the short vol trade. It takes a lot of capital tied up to open those positions, and you'd be far better off trading defined risk short vol strategies. You'll make more money, and you'll have less risk on the table. So for both of those reasons, it really doesn't make any sense to be doing that. People look at the juicy premiums and they take the easy route and they just say, well, I don't want to calculate anything. I don't want to be efficient with my capital. I'll just sell those calls. I implore you not to do that. It's a really capital inefficient trade, and you will make more money long term if you stick to spreads like butterflies or verticals or the good old iron condor. Those are definitely long term going to make more money, and you'll lose less money as well, which is obviously a bonus. Number three, never over allocate to a trade regardless of the opportunity. This is one I think that's important today, of course, because judging by my emails and how many people demanded that I do this live stream follow-up, there's a lot of people thinking that this is the opportunity of a lifetime. Now, fine if you think that, great. I'm not here to tell you it's not. Maybe it is. You want to be very, very careful with that type of mentality, because a lot of times people think that this is it. If I miss this one, the next one's going to be 10 years from now. I'm just going to go for it. I'm just going to go all in, Wall Street bet style. Not a good idea. Opportunities come all the time. All the time. It may not be exactly like this. It may not be Barclays literally, halting share creation. This probably won't come around very often. But if you're a trader and you're immersed in the market, you're going to see all kinds of opportunities in the future. So no matter how good of an opportunity you think this is for yourself, remember to keep your allocation size in line with your risk tolerance. And that applies also for people who have been trading something that's been successful for a while. It's very dangerous because oftentimes we're all human and we feel like, well, it's working so well, let me over allocate to that position. I've made that mistake as well. I made that mistake recently, went a little too heavy on the NASDAQ, and of course we've gotten punished by that decision. It happens to the best of us. Not claiming to be the best of us, but it happens to everybody. Don't do that. You will always find other opportunities. So keep it in line with your risk tolerance, whatever you do today, or this week, next week, whatever you do. Number 4, always assume the worst can happen. This is an emotional thing. It's a psychological trick that when people see opportunities, they're always looking for the best case scenario. They're always looking for, here's how much money I can make. They're looking at the trade and thinking, oh, this is what's going to happen. It's the VXX. Of course, it's going to do this, and I'm going to make X amount of dollars. What you really want to do is play devil's advocate with yourself. It's fine to set up a trade and you're looking to make money. Obviously, that's the goal. But you want to play devil's advocate all the time and say, okay, let's take a step back here. Where can this trade go badly for me? What series of events could happen that maybe I'm not anticipating, that maybe I think is a low probability, but what could happen? Let me make sure I'm still going to be okay if the worst case scenario happens. Don't ever open a trade that you're thinking to yourself, well, I'm probably 90% okay, and as long as that terrible thing doesn't happen and that'll cause me to blow up, then I should be fine. If you can play devil's advocate and find reasons and poke holes in your strategy and your hypothesis, don't do it. Number 5, of course, have a plan before you initiate the trade to reduce emotional mistakes. And what I mean by this one is, especially in a trade like we're going to go over here with the VXX, this trade structure specifically is going to require some of the trade setups to go deep into the red zone. Let's say you're taking a short bias trade, and I'll get into 3 options in a few minutes. It's probably going to require you to be open to the possibility that as long as the share creation is still halted, your trade might actually go into the red. You need to prepare yourself emotionally ahead of time for what you're going to do and how you're going to respond if you see this trade starting to go a certain way. Think of it ahead of time, because then when it happens, you're not going to make any emotional decisions in the moment. You're not going to panic sell. You're not going to do anything stupid. It's all part of the plan. So basically, all of these rules of engagement are a way of saying, calculate everything. And then when you're ready, go ahead and make your action. Now, the other thing that we, of course, need to talk about is the fact that this trade specifically in the VXX, given what's happening with Barclays as well, given that there's a Fed meeting in less than an hour, this is a multi-factor trade. There is a lot of moving parts going on here. So first of all, I hope you know this by now, but trading VXX under these circumstances is going to be a race against the inevitable. It will return to the indicative value. So what I mean by this, remember yesterday I taught you how to look at how far above the indicative value it is. Because Barclays has suspended the share creation, the VXX, which typically just flatlines where the NAV equals the indicative value, because that mechanism where the authorized participants come in, they get to arbitrage that difference between it because Barclays can create or redeem shares and they market at a price where if it deviates, they can just snap it back all the time. Well, we've decoupled because they've frozen that. So now VXX is trading essentially like a stock that you can't short, and it is for the first time ever being traded based on supply and demand. But you have to know that as soon as that announcement hits the board, as soon as they get everything, whatever happened behind the scenes, once that gets fixed, it's actually quite quickly going to revert back to the indicative value. So very quick warning here for the Wall Street Bets people. They haven't actually attacked it yet, which surprises me. But warning to the Wall Street Bets people, this is not a stock. This is not the same situation as AMC or GameStop. You do want to be careful with this because when that happens, and it will happen, one of two things is going to happen. Either the bank is somehow going to scuttle the product, which I think is highly unlikely, or this is going to get fixed. They're going to find some way to get it fixed. Maybe soon. We don't know. But when that happens, it doesn't matter how many chat forums are going after this thing, how many of your friends you can drag into the same trade. It's not going to matter. You're going to be battling against the Barclays and the authorized participants, and they're just way stronger and way better equipped to bring this back into line. So it's going to happen actually quite quickly. I would imagine before the end of trading that day, and certainly within a day or two, nearly all of it's going to be back down. I would imagine that's how it's going to go. So you are basically, it's a race with the devil here to get your, if you're on the long bias, you want to get a little bit of profit, and then you kind of want to get off this train, because at some point it's going to smash into a brick wall when they finally fix this thing. Number two, it may go a lot higher than people think. So I'm referencing 2012 here. Essentially, when this happened in 2012, you can see it hasn't totally decoupled yet. It got a little frisky there for a while, which was exciting to watch, but it hasn't actually gone that crazy. TVIX, back in 2012, when a very similar thing happened, different underlying reason for the share halt, but same basic outcome is that the authorized participants can no longer do their job. And so it decoupled by almost 90% over about a 1 month period while the shares were halted. So don't be surprised if, like I said, this is looking reasonably calm right now, but just when you're structuring trades, don't be that guy that says, oh, this will never happen, or it's never going to get to that level. Understand, yes, it can. Any and all outcomes are on the table here. It could go to the 90, like the old TVIX. It could go to 200, like Wall Street Bets probably wants it to do if they get involved. It could do anything. I mean, how many of us said AMC could have done what it did? I know I didn't see that one coming, so I'll be the first to admit I was shocked how high that one went. But don't be that guy who structures a trade saying this XYZ can never happen. Yes, it can. Also, it may not go higher at all. I don't know how many long bias people are in the chat right now, how many are short bias, but if you are a long bias person, you have to understand that it may not do anything. I know you've probably perused the news and it all sounds terrible and wow, this thing's a supply and demand product. This is going to be absolutely crazy. There's X short interest and they're trapped. We're going to get them. It might not do anything. It really might. So consider that as well. Don't structure a trade thinking that for sure this thing is going to just to the moon like the AMC crowd would say. It could just do nothing. Move that window. Next. Importantly, especially if you're going to be on the short side or on the long side, actually, we don't know when the share creation will resume. No idea. Now, I've also already started seeing people on Twitter releasing things where they say, I've got a contact or I've got a source that told me it's going to be on this day. Sorry, I'm not insulting anybody, but no, you don't. There's no way Barclays is going to release that information to us peons. They're just not going to do that for us. So it's going to be a surprise to everybody. Nobody knows when it's going to happen. The only reference point we have is that in the past with TVIX, it lasted almost a month. If this is a very small regulatory blip behind the scenes, it's possible this thing starts today or tomorrow or very quickly. It's also possible that it lasts a few weeks. It could last a month or longer. We have no idea. If I had to, gun to my head, ballpark it, I'd say it's either going to be 2 days, starting from a day ago, so tomorrow, or 3-ish weeks. If the issue actually was that they just are having difficulty securing good premiums for those hedges, I don't think that'll snap back that quickly, but, stranger things have happened. It absolutely could. So just understand that time frame is a total unknown as well. That's why this is just a multifaceted, very difficult trade with a lot of moving parts going on here. Lastly, I do want to remind people that even if none of this was happening, the VXX also has a natural decay factor, plus it has the ability to spike on us. I'm just going to open up a spreadsheet here because I actually forgot. Sorry about that. Should have had this open already. But even under the best of times, the VXX is a difficult thing to predict. So now we're adding on a Fed meeting. That would be an insane market environment already. If this VXX stuff wasn't happening, I'd still be live right now talking about the binary event that's about to happen. So let's not pretend that this is going to be just a Barclays trade, just a race against share creation. There's a whole nother aspect of this thing that it just makes this thing difficult. And if you were the type of person that you wanted to sit on your hands and just sit this one out, wouldn't blame you a bit. This is going to be a trade that blindsides a lot of people. There's going to be people who make money, but no, this is not going to be nearly as easy as I suspect some people think it is, especially if you're following people on social media. There's a lot of people very confident they know what's going to happen. And I am never one to shy away from telling people that I don't have a crystal ball. I don't know what's going to happen. I like to control my risk, control the things I can control, reduce the number of variables as much as I possibly can. And then I don't know. Beyond that, I really don't. So let's get into a few trades so we can actually start talking about something. Now, quick reminder, this is a live stream. This is going out to a large audience. I have to speak in generalities. So I have to choose a few trades. Something I often notice in the YouTube comment section, when I make a video about a specific topic, people will make the comment, well, why didn't you include this? Why didn't you include that? I would if you wanted to watch a 3-hour video. I would definitely do that. But this is a general audience. So these 6 trades, these are not like the best 6. Sorry about the little clickbait thing there. I think I said top 6. It's not the top 6. It's just a good foundation of trades that you can work off of. You still want to apply your risk tolerance to these, and you can make adjustments, and you can change the structure, the strikes, the duration if you want. Pick the trade that I'm going to go over that suits your personality best, and then expand from there, basically. I'm not going to be able to cover a full wide variety of every possible scenario. So I have chosen just pure option trades, no pairs trading, no arbitrage type stuff. But a couple of reminders, again, we don't sell undefined premium. So you're not going to hear me talking about naked calls. I also don't like buying expensive options. Right now, volatility is elevated. It's not a good idea to walk into that Vega headwind, so we don't buy long puts either. So if people are in the comments saying, look, well, I think VXX is going down, just buy a long put. Nah, it's not a good idea because volatility is too elevated. You do want to take trades that have both a long and a short strike whenever possible. You're basically eliminating one of the variables by taking a little bit of that volatility component off the table. So the first thing is a short call vertical. Just going to check the market here. We're up 1%. It was raging higher for a while there, and now it's sort of dipped down. Interesting action given the Fed is coming up. But here's the VXX. So the first trade here, this is a short vertical for May. Now, why was I choosing May? This is important because if you look at right here, this is the option string. We've got choices here. Now, because the short bias trade is basically playing against the idea that at some point this is going to snap back. Now, again, the VXX moves on its own as well, independent of all this Barclays stuff. So it's difficult to take all of that into consideration. But at some point, they're going to release the news that the share creation is on again. It's functioning normally. There's going to be that snapback. So what you want, essentially, is you want to wait. You want to structure a short bias trade that has enough duration to cover when that's going to happen, because as long as it doesn't happen, the short trades that we set up probably won't be profitable. It's unlikely that they're going to go down enough to be profitable. So this trade does involve some patience ahead of time. That was one of the steps that I talked about. I have to know ahead of time my plan. And my plan is to allow the trade to bleed down into negative territory more than I normally would, because this is just waiting out an announcement. So we need duration. How long? You could consider April, but nothing wrong with stretching it out to May as well. It's a vertical, so it doesn't matter that much. Highly unlikely that it's going to go to expiration anyway. What is essentially going to happen is you're just waiting for that snapback. So if we took this trade, for example, this is a short vertical call spread. You can see the minus here, that's the 24 strike, and then the long 25 call. And here's the price right here. So this trade profits if the VXX goes down at expiration. Now, the reason that I'm kind of doing this in the money, you don't have to. You could go, where is it trading now? 28. You could see what it looks like if you did a true just out of the money. Of course, you're not expecting it to look quite as nice. The risk reward is a little bit off balance. But again, this trade's not going to be open till expiration. So you want to try to avoid, look at those prices. I should lock these. You want to try to avoid looking at the turquoise line because that's the expiration. This is just a day-to-day trade. And as soon as that announcement comes, if you do get that drop down, it's going to be fine. The reason that I did the 24 is yesterday I also told you how to just look at the indicative value. So if we do VXX dash on Yahoo Finance, in Thinkorswim it's a dot, in Yahoo Finance it's a dash. We're going to check the IV here, and it's looking like it's 24.26. That's what it should be trading at. This is the intraday indicative value. What VXX is actually trading at is 28. But we can use that 24 if you wanted as your short strike, because that's essentially what we're targeting. Now remember, VXX is also going to be moving on its own independent of what's going on. So if you set up this trade and Barclays hits the announcement and it seems like it's working, if the VXX itself had a spike, like let's say the market reacts poorly to the Fed announcement and it spikes up, well, guess what? Your trade's going to lose anyway, even if you got the bonus from the Barclays little assist there. It could still lose anyway. But that is a possibility. That is your standard short call vertical. Second option would be an out-of-the-money butterfly. Again, this is a short bias trade. I'm choosing the same expiration because we want a little bit of duration. Again, it's not going to matter. We're not holding this to expiration. But the butterfly option, out of the money, again, targeting that 24 strike. Now, this is one of those situations where if you wanted to, you could lead the VXX further, because what you're looking at here, this is the average VXX decay factor going all the way back, simulated numbers back to 2004. Okay, this is a 1 times long volatility. This is what it looks like. It decays 0.238% per day, per week, minus 1.2 basically, and per month, nearly 5% a month. So these are the long-term decay factors. And since we do have the VIX futures term structure roughly flat, we can assume that these are pretty decent numbers. If contango was 10 or 15%, you'd want to lead it a lot more than that. But right now, these are decent estimates. So you could expect about 1.2% per week as long as the VXX is bouncing around and not doing anything. So if you think this announcement isn't going to come for a couple of weeks, you could actually go a few percent lower and you could take it down to something like a 22, I don't know, 26, 18. Strikes don't really matter, but you could do something like this, and you're basically hoping that your VXX goes from right here, you get the announcement, it snaps to the indicative value, VXX also has its natural decay factor, and you're looking for a target range somewhere in here. Not risking a whole lot of money here, potentially making a pretty good return. I love butterflies personally. Everybody in the VTS community knows that. So when I see these trades, I think, well, this is pretty solid. So very low capital outlay. I'd rather take 10 contracts of this than any short VXX call, UVXY call, every day of the week. This is a far better trade. So that's the old butterfly, and I really like them. So that's an option. The third one, again, trusty Iron Condor. Everybody probably knows the Iron Condor. If you've option traded at all, you probably are familiar. If you Google options trading, typically puts and calls and Iron Condors are probably going to be what pops up for you. And the Iron Condor is great, again, for the same reasons that the butterfly works. You can sort of lead the indicative value snapback, right? Let's say that we get that snapback. We're going to get a little bit of drop. Oh, there we go. A little bit of action there. Wall Street Bets is waking up this morning. They got their coffee. They're ready to go. So you're going to get a little bit of a snapback to whatever it is. This is a moving target. Remember, these are not exact numbers. Always it's a moving target. But account for a little bit of decay. You could even move this down a little bit. Or if you think the Fed announcement's going to go terribly and it's going to spike up, well, you might want to wait for the announcement first of all and then get the trade on after that. But you could also put it over here. You can put this anywhere you want. I just think that if you're doing a short vol bias trade, you probably are also a little bit short bias the fact that the VXX typically goes down as well. Unless something crazy happens today, we're probably going to get a little bit of a vol crush, and that might go down as well. Now, if the market hates what they hear, well, any and all possibilities are on the table. Like I said, these things can go as high as we could possibly imagine. But those are your 3 trades. So as far as short bias, I would start with some variations of these. I would start with short call, out of the money butterflies, OTM iron condors. I think those three are going to get you going. You're going to have some ideas branching off of each one of those. It doesn't have to be set up the way that I did. Like I said, this is a public, hundreds of people are going to be watching this, so those are very general. But you know your risk tolerance better than I do, and you can certainly use those structures to match up your trades. Check out the comment section, see how many I have to go through later. Yeah, this is just idea generation. So let's give you some more ideas. Let's talk about some long trades. Long bias trades. Again, a couple of reminders. We don't want to buy expensive volatility, so we are not going to be buying long calls. We're not going to be doing that OTM, AMC nonsense stuff. You're buying incredibly expensive options at that point. Again, default to my YouTube channel, I actually put a lot of effort into these videos. I know sometimes it doesn't look like it, but my production value is incredibly low. I'm sorry, they're kind of boring. I tend to be kind of a dry person, but there's a lot of videos here and there's a lot of stuff. So if you go to the videos, we did a full live stream on how to fade the VIX. One of the central topics I talked about in this episode 29 was actually the fact that if the VIX spikes to 30 and your first thought is I need to buy VXX put options, you're paying a lot for those contracts. And even if the VIX goes back down to 20, you're probably not going to outpace it. You succeeded on your delta directional exposure, but your Vega's going to eat you alive. So you're probably not going to make money doing that. And the same thing applies here. Volatility is very high. You can even see it. If you want to just an example of how this can happen, let's just take anything. Let's take this trade here. Let's just take a long call. Set that up. Here's your standard long call. I just want to illustrate what's happening here, because if you go over here to the VXX, we can see that volatility is significantly elevated on the VXX. Implied volatility right now is about 150. A few days ago, it was 112. So we're at least 40 or 50% elevated on volatility right now on the VXX. Now, why is this a big problem? Well, because what is Vega? Vega is the option Greek that tells you how much, or it's an expectation, just a rough calculation, but gives you an idea of what your option contract will look like given a 1% move in the underlying. So that's what Vega is. If we're 40% elevated right now and that flushes down and crashes, you're talking about a 40% drop. Your delta is never going to be able to make up for that drop in your Vega. So this is Thinkorswim. Hopefully you really know how to use your own software. You can do this as well. But if you just go over here and you just do a minus 40 adjustment, minus 40, that's minus 50. Microphone's in the way of my keyboard, so. You can see what happened is that the price didn't change a bit, but this contract dropped about 1/3 of its total value immediately. That's what's going to happen. It's just Vega gets flushed out of this trade. So even if you don't have any price movements at all, you are still subject to pretty large changes. When you look at your option string and you see your Vega, you might think it's a small number, but 40% of a small number is actually 40 times whatever that number is. You're looking at a potential walking into a Vega headwind. Let's put that back so I don't screw up the rest of the live stream. So there we are at 0. If you're going to do a long bias trade, okay, the long bias trade, I think, again, this is just speaking in generalities, but I think you're probably doing it because you're looking for a little bit of a pop. You're looking for at least moves like this that happened. And remember, TVIX went way higher than that. It went 90% over its indicative value. I think you're probably looking for that. You're not setting up a trade so that it just bleeds a little bit. So for me personally, if I was to take a long bias trade, I would be looking for quite a significant pop. So when I'm doing my long call vertical, what I would do is I'd probably just go 50% above the price. And I'm just hoping that something happens, a bunch of people catch on to this trade, they understand that without that share creation, it really could go quite high. Let's start with our strike price way up here so that we can boost our potential profit. On the long side, we can also reduce the duration on the trade because this trade is not going to be open for very long. Remember, I said You are in a race with the devil here if you're going to go long this thing. As soon as that announcement comes, you do not want to be long VXX when those shares resume their creation process. You really don't. Take my word for it. You're not going to be able to fight that headwind. So this is a shorter duration trade than the long. Remember, the long, you're trying to stretch it out past the announcement so that you can get that snapback. This one, you're trying to ride it and then get out before the inevitable crushing of our dreams if you're long VXX, because that's what's going to happen. There's going to be a lot of people who potentially are sitting on a nice little profit. They think they're a genius. Look at all the money I made. You are subject to a 5-minute drop of all that profit. And unless you're right in front of your computer, it's going to take everybody by surprise. So let's just start the vertical at 40, right? You could do right at the money. You could just start your vertical here, try to do some type of 50-50 setup, but why not go for a little bit of additional profit, right? This trade is putting up $43 to potentially, if you ride this pink line and the apes, I don't know if I'm being insulting when I say that, but the apes at the Wall Street bets, let's say they start pushing this thing, you could make 4 or 5 times your money doing a trade that you're really not putting that much money up in the beginning. Now, if they announce it, snaps down, you make nothing, right? Of course, there's going to be very little capital left in this trade if you stay in it too long. But that's the long call vertical. I like verticals as you, oh, sorry, I didn't highlight it. As you know, it's kind of the standard go-to. They don't always work. I don't actually trade them. They're not my most common trade, but it's a really good starting point. So you look at it, you think, does this match my risk tolerance? Does this match my personality? If it does, it's actually a trade that can be put on pretty much all the time because it involves both a long and a short strike, so you are reducing a little bit of that Vega headwind. Still a little bit there depending on the width of your strikes, but it's definitely reduced a lot. The second one, you knew I was going to say it. Of course, everybody who knows me knows that I like my butterflies. But this time we're going to do a slight variation. So your standard butterfly is going to look like this. And again, we're going to do out of the money because we're going big here. We're going big or going home. We're putting up a tiny amount of capital to potentially get that boost. This is a fine trade, just a standard equal butterfly out of the money. Nothing wrong with this. But if you break the wing, one of the wings, you're actually going to drag it down a little bit. I like this type of trade a little bit better. You can break the other wing if you wanted. I mean, if your bias was that way, you could make something look like this, right? So you're risking nothing. You're making a little bit if it goes up. You're losing your money if it goes way, way up. You could do that, and that might match your risk tolerance. Broken wing butterflies are awesome because that's basically choose your own adventure type of trade. You can do whatever you want. But something like this looks pretty good to me where, again, you're going to need this thing to go up and you're going to need to close your trade before the announcement. But this is fine. And depending on your risk tolerance, you could take all types of variations off that. That's a really nice trade there. The last one, be a little bit careful, pay a little bit closer attention when you're trading calendars because there's a little bit of an additional volatility factor to calendars. But I like them. I trade them. So the one that I chose is this one. Again, the 40 strike. You can see a calendar is comprised of a short on the near month and then a long on the far month. So this is why I say there's a little bit more of a volatility component because you're dealing with implied volatilities of 2 different months here. It's not going to be a uniform thing. It's going to change dynamically as you're looking at it. Let me lock this so it's not bouncing around. Max loss is still going to be capped, so you're not risking very much here, and you could potentially make a decent chunk. But when you do your volatility adjustments, that pink line, right, we're going to watch the minus 40. You see what happened. Basically, half the premium is gone if this thing snaps back. And then, of course, the delta is going to suck out the rest. So calendars can move quite quickly. They are a long Vega trade, at least for a while. And what you're really hoping is that you capture a little bit of the premium. This, not only is the price going to go up, but contrary to what usually happens, if the VXX continues to climb like that, you might actually see implied volatility go even higher. I would expect that to happen. And you're going to get a nice boost from that as well. So it's going to be a nice delta trade, and you might even get a nice implied volatility bump. Of course, the opposite is true, and you can lose more if it goes the other way. That is always the case with options. Glass half empty, glass half full type of thing. Some people will look at it and go, wow, look at how much money I can make. Some other person would look at it and go, yeah, but what happens if that volatility gets sucked out? Depends on how you look at these things, but there you go. So I would say those 6 trades, 3 short bias, 3 long bias, you're going to be able to work something off of that. I suspect there's going to be something that looks good for you that you think, wow, that one caught my eye. That's the one I'm going with. I would say, remember, above and beyond everything else, if I can leave you with one thought here, sort of a couple thoughts tied into it, we have no idea what's going to happen. So play, have fun with this, do what you're going to do. Please trade and size your trade accordingly, because the number of variables in this thing, it's VXX, it's VXX options. There's a Fed meeting coming up. We're in the middle of a Ukraine invasion. We've got all these things that under normal, no Barclays problem, this is going to be a nightmare to trade. And then you're going to throw on top of the fact that there's a ticking time bomb here. When they finally get this thing fixed, the party's over. So I hope I've painted a picture that this could be both a lot of fun, but very punishing, and it's going to make a lot of people very sad if this thing goes the wrong way. So go ahead and have your fun. I probably won't. None of those trades are anything that I can put enough capital on to really make it worth my while. I make a really good rate of return in my investments. My options trading is kind of a well-oiled machine at this point. I don't need to deviate from that. I've got a community's kind of been put on hold, but I've got 10 option strategies that I bounce around between, and I've got all my trades that got the risk-reward ratios figured out. I don't really need to deviate too far from that, so just full disclosure there. But you go ahead and do your thing. If this is something that suits you, go for it. I say that it's fine. So what time is it? We've got the Fed meeting. I'll do some questions. And we'll also VXX minus VXX.IV. 57% now. So not much happening yet. That must mean the market itself about 1%. So let's do some questions as we're kind of eyeballing what's going on with the, sometimes I like to go to just Yahoo Finance. Sometimes I'll check out Twitter, see if anything too crazy happened. Remember yesterday I referenced, you definitely want to go ahead and follow Bill Luby. He's awesome. All right. Anyway, let's do a few of this. Oh, you weren't watching any of that. Okay. That's okay. Let's try to get a few of these, and then about 5 minutes out, I'll stop and we'll all watch the Fed announcement. So it's a non-issue for me. I don't day trade. My positions are on. I'm basically long gold, long real estate. I can actually show you. It's a very, very simple allocation right now. This is both my portfolio as well as the VTS Communities portfolio. I'm long gold in the tactical balance strategy. I'm long IYR real estate in the strategic tail risk strategy, and I'm long XLU utilities in the defensive rotation strategy. And the fourth strategy that we do trade that has another 25% allocation, these are all 25%. The fourth strategy is in cash. That's our VXX butterfly strategy, also UVXY butterflies. So given the nightmare in Barclays, I can just jump over to the UVXY. It's fine. It functions exactly the same way. But right now, just given the possibility of severe vol crush, if this thing goes, I mean, if the market loves what it hears, the VXX could really suck down. The UVXY could drop a lot. And that's when I would start initiating my butterflies. I wouldn't want to do it ahead of time. So that's what the portfolio looks like. It's very simple. I wouldn't say I'm indifferent to what the Fed does, but I'm not, on pins and needles here. I'll just deal with it when it happens. So here we go. Say they resume issuing shares of VXX. The primary reason I can think of for VXX trading significantly below indicative value instead of above is default risk of Barclays. Can you think of others? There wouldn't be any reason it would deviate at all. Remember, The products function completely normally under normal circumstances. It's actually a question that came up today. I should actually answer that now. Somebody said, well, hey, if you back this up a long period of time, you can see that it actually went up hundreds of percent, right? So if we go daily and we go, say, 5 years, what are we going to see? Well, we're going to see totally normal functioning here, and then we're going to see this crazy action we've seen recently. But what is going on here, right? The person says, well, clearly this product doesn't work. Well, what's going on is on this date, this is April 21st, 2021, there was a reverse split. So, of course, it just messes up all the charts going backwards. But believe me, this thing was flatlined the entire way backwards. That's what you're looking at. So to answer your question, no, I'm not going to say it's impossible, but it would be crazy. It would be broken the other way. There is no reason to expect that this thing won't match up extremely close to the indicative value as soon as everything goes back to normal. It's not going to overcompensate and dip below. It is an ETN. There is always credit risk at the bank. That's the difference between ETFs and ETNs. ETFs are assets. They hold the underlying futures in that fund. ETNs, exchange traded note, it's a debt obligation. It's essentially an IOU. The bank says, okay, you buy my thing, you buy my ETN, and don't worry, I'll pay you what the value is. And then behind the scenes, they're doing a bunch of borrowing and they're doing a bunch of, maybe hedging out with futures or however they're going to hedge it. And they're just going to pay you your money that way. But it's not actually holding the underlying assets. So in the event of a solvency issue with the bank, you're in trouble. So it's an ETN. But no, it's not going to snap back like that. It's going to go back to normal functioning. It really will. I know it might not seem like it now. Everybody loves to hate on vol products, like they're broken, they're manipulated, the Fed is transferring money from the rich to the poor. I don't know about all that. This is just how they work. So I'm expecting it to go back to normal, and honestly, there's no reason why I wouldn't trade it the next day. As long as it's functioning normally, I'm going to just try not to have any emotional bias towards it. VXX will be fixed as soon as that share creation starts again. No reason to be afraid of it going forward. Okay, Marky Mark, best option structure to express your view that a market has bottomed, unrelated to the current sell-off. So just in general, a market has bottomed, what am I looking for? Looking to limit downside if I'm wrong, unlimited delta gamma upside, but also short vol. What I like to do, and this is just top of my head, if you give me enough time, I can think of a list of 10, but something that I like to do is iron condors. But what you'll want to do is don't jump into your iron condor as soon as the market bottoms. So let me try to find an example of a market bottom. Gee, I wonder. Let's try to, well, something must have happened right around March of 2020. I don't know what it was, but here we go with a market bottom. There's no way you're going to be confident that the market bottomed here. So let's not get crazy and think that you called it on that day. But if you were trading this and you thought, you know what, it's kind of recovered here. It's looking strong-ish. Right about here is when people will start to think, I wonder if the worst is over. I wonder if that's what happened. And I'm seeing strength here, so this is a pretty good entry point for a, like you said, market has likely bottomed. If you open an iron condor here, volatility is through the roof still, so you're going to get very wide wings. You're going to take this trade out, and I don't want that circle. You're going to take this trade out into the future, and you're probably going to be able to cover a range that looks like this with your iron condor. So it's actually a fairly well-protected trade. Like you said, you don't want to be totally blindsided if you're wrong, but iron condors work really well as long as you don't open them at the tops or bottoms of anything, which nobody knows when that is. But if you see some snapback and it's sort of in a middle-ish range of an ugly trough down, that's when you can actually take a pretty good risk-reward iron condor. So that's what I would say. I love iron condors, and as long as volatility is elevated, if it's mid to high, you can slap them in almost anywhere, but you're going to get a little bit extra boost if you don't do it when it's just the day of a reversal. Give it a few days, then slap it on. You're going to have a very high success rate with that trade. Okay, how do you make sure you don't overfit your data for your strategy? Example, over-optimize data for one event to have better back-tested performance. I think you're getting a little bit too close to the secret recipe of VTS and my strategies. but one thing I can tell you is that very little of what I do is up to backtesting these days. And even back in the day, 2008, 2009, when I was building a lot of these things, now it's more maintenance and small changes over time. But even back when I was building them, backtesting was only part of what I do. Of course, I live trade for probably 1.5 to 2 years before I actually do anything with significant capital. So I want to make sure that I've hit at least one good period, bad period, choppy period, get a little bit of everything in live capital trading before I'm actually ready to do something. But if I am backtesting, another little layer that I do, because overfitting is a problem, curve fitting is definitely an issue, I don't optimize for performance. So this is helpful for me that when I'm backtesting, I'm not actually looking for the best performance. I could tweak things to make it look like, oh, this threshold 42.65 worked perfectly, but 43, that was not very good, and 44 was awesome again. And I could design it so it's the perfect backtest, and it would just look crazy. That's why on Twitter you'll see people post these things that are like totally ridiculous performance they will never repeat in live trading. I don't do that. I optimize for trade frequency. I optimize for reduction of drawdowns, things like that. How much of each asset class I want to hold. It's a little bit dangerous to optimize for pure performance. So, but then again, even if you did that, you'd still want to live trade for a significant amount of time before you deem that a strategy is as good. As the old saying goes, if I had a nickel for every time I've seen a crazy good-looking backtest, I'd be sailing on the French Riviera right now in a yacht. So 99% of backtests are going to fail in live trading. Give them a year and they're all going to fail. So you want to make sure that you're not optimizing and overfitting, and then you also want to just take it for a drive for a couple years and just make sure. 152, meeting coming, imminent. So what's everybody's prediction for what's going to happen? What's everybody thinking? Is it going to be 0.5? Is this going to be the weakest, just little, there you go. I know you're expecting us to do a rate hike. Here's a little 0.25 for you. You think it's going to be a 0.5er? Or do you think they're going to shock the world and either do 0 or a 0.75? Me personally, go ahead and leave your thing. While we're taking a few minutes here, if you would be so kind, give me a like, hit that video, just take 10 seconds and smash that like button. Sorry, girl. Pulling you back into the shot. Yeah, I'm thinking 0.25. I'm thinking that the way this is going, I'd be shocked. I did a poll recently, and most people seem to go towards the 2 rate hikes at 0.25, and then they're going to be done. Honestly, I would not be surprised at all if early 2023 we were doing QE again. We were doing rate cuts in QE again. I just think that if they go too quick, I mean, there are some banks out there that are predicting 7 or 8. I've seen as high as 9 rate cut or rate hikes. No, that is not going to happen. Absolutely not going to happen. So we'll see. Just looking at 0.25. AGM 0.25 and bearish response. Okay. Kevin 0.25, and we'll monitor and use our tools. That's a good call. That's actually what I think they're going to do. That's right in line with what I'm thinking. They're going to say something to make us think, no, we're serious. It's just not quite yet. 0.25 for John there. 0.25. Phil 0.25. I think that's the general consensus. I saw 1.75. Where are you? Where are you, my 0.75 friend? 0.75 raise. Nah, that'd be strong. That'd be aggressive. I don't know if they're ready to do that yet. I'd like to see the response. I'd be very curious if in 6 minutes from now, 0.75. How cool would that be? Yeah. The economy's brutal. Next week, I'll probably get around to doing that one live stream. Just it drives me crazy, especially when asset managers with letters behind their name say that the economy is strong. That really irks me. If normal people say it, I'm kind of, totally strongly disagree, but I'm fine with it. But whenever you see asset managers with, CFA, CPH, whatever they have, and they're telling you the economy's strong, you got to know that you're talking about a largely net long buy and hold manager whose entire management fee structure depends on the stock market continuing to march higher. There's no way this economy's strong. There's nothing strong about this economy. So I'll die on this hill that this economy is incredibly fragile, and I would love to see what happens if they do a 0.75, 0.25, a 0.25 for sure in a month. So, mid-meeting hikes. Interesting. Total of 0.75 in 1 month. That's even stronger. That's worse than doing 0.75. Not worse as an outcome, they could do it. But I'm saying that might actually startle the market even more. That would look like they're kind of fumbling around a little bit. They're doing 3.25s. I don't know if that would be taken very well by the market. I think that would almost certainly collapse. 0.5 today. Could be. I think they should do 0.5 today. I think they should do 0.5, and that gives them room to do another 0.5 in June, which is what I think they should do. Or if the reaction is bad, they could scale it back to 0.25. Still, they can appease all the people that want to see hikes, but they can sort of ease the people who think, hold on, we're not going 0.5 every meeting, are we? I think that would be the sort of the middle ground here. Go 0.5, strong out the gates in March, and then it leaves a little bit of room for adjustment. That's what I would do. Although I wouldn't have had this economy in the situation it is. I would have just taken the medicine 5 years ago and just done this already. It would have hurt, but I think people would have thanked me for it later. But now we're in this grim situation where there's really no way out. 0.25 4 times within 6 months. Again, strong, going mid-meetings, going off quarterly. I think that might be taken as bearish. I don't think they're going to do that, but hey, everybody gets a vote today. Another 0.25 or 0.5 in 2 months. 3 minutes left. My vote's in. It's going to be 0.25, but I want 0.5. And of course, I don't think it matters anyway. I think it's just far too little too late. And no matter what happens, I'm actually an optimist. I'm not one of those dooms people, but I think the market is going to have to take its medicine. At some point, you can prolong it as long as possible, but at some point, we're going to have to do this. And that's, again, one of my pet peeves with all these. Almost the entire financial industry is highly financially incentivized to keep this thing going. So you got to be very careful who you're listening to when it comes to the economy is strong. Is the economy strong because you're worried that people will cash out their portfolio and not give you the management fees? Or is the economy actually strong? Go out in the street and ask the first 100 people you see. I bet you the responses are a little bit different than the first 100 asset managers that you see. So, yeah. We'll get into all that next week. I feel a rant coming on. I feel like I'm gonna go off a little bit because it really drives me crazy. So I'm just gonna look online here. Go to what are we gonna go to? I don't know. Is it weird that because I'm not a day trader at all, like I'm not a short-term intraday type of guy, a lot of what I do is off Twitter. I don't post on Twitter very much. You can see I've posted 6,700 times. It might sound like a lot, but that's not really that many tweets, to be honest. I've seen people with 40, 50,000, 100,000. But a lot of the things I do is just kind of scroll Twitter and I follow certain people. I definitely follow Bill Luby there. See what's happening. Converging on about 4 points, at least for now. Yeah, it went up a little bit. Good call there. Tomorrow we'll find out how much the Fed really cares about the stock market and the VIX. I don't know why that would be. Do I follow this guy? No, somebody else bumped it. Yeah. Here we go. So I think we can actually get the headline either on Bloomberg or Yahoo. But what I also like to look at sometimes is I like to just watch the intraday, because what you'll find happens is there's going to be a real shakeout as soon as it starts to go. So you'll either see a big green bar, you'll see a big red bar, and then it could very easily chop around and just go bonkers for about 20 minutes. And that's why it's just best practices not to trade around this announcement. It's fine if you want to get some last minute stuff going, but as soon as it goes, don't be that person that's super tempted to jump in. Like if you see a big red bar, it's a sell, everybody's dumping, I got to get out, sell, sell, sell. You might find that 15 minutes later, the market's absorbed the news, it's fully recovered, it's actually closes green on the day. So my suggestion, obviously I can't tell you what to do, but don't trade the afternoon of a Fed announcement or any type of announcement, any binary announcement. Don't trade if the debt ceiling thing seems to be resolved. Sometimes the market loves it, and then 20 minutes later, it's a sell. Sometimes they absolutely hate it, and then it's a buy. So just sit on your hands and watch. That's what I always do. I'm not taking any new trades until tomorrow, no matter what happens right now. No matter what we see, it's just, for me, I'm going to wait until about 2 hours after the market opens tomorrow. I'm going to input all my volatility data, and that's what I'm going with. So whatever happens now, it happens. It's red. Let's see how quickly the people in the chat can figure out what's going on. Looks like it's 50. Not sure if I'm reading it right. That's what AJM says. It is 25, Winston says. You can see I'm not much of a trade the news type of person. Typically I'll be doing this on Bloomberg, but wow, Yahoo usually has it within seconds. I'm going to rely on the chat. I'm going to rely on all of you in the chat because you're probably much quicker than me. 0.25. Bullard wanted 0.5. Well, I wanted 0.5 too. But the market's just going to shake out no matter what happens. It's going to do its thing. You're going to see some... This is just standard stuff for one of these. It's going to shock down or shock up, shock down, bounce around for a little bit. And then the market's going to decide tomorrow what it's going to do, basically. So... looks fine-ish. So we can check out some other asset classes as well. See what gold thinks about this announcement. Little shocky. Let's check the TLT. Nothing. That's surprising that everything else is moving faster than the TLT. IEF is what I typically trade. 7 to 10-year treasuries. Just moves a little bit slower. Let's check IYR. I'm in that. Let's check XLU. It was having a rotten day so far. Recovered a little bit, down a little bit. What else can we check? Emerging markets, DBC, you can check the commodities, you can check the US dollar. Nothing too exciting here. So stock market, that's looking like a little bit of disappointment. So whatever the announcement is, Fed raises interest rates for the first time. 0.25. So who was it and they just nailed it? I would imagine if we read that announcement, it's going to say something as positive as could be. But, yeah. I think the market would have probably been happier with a 0.5. Like I said, my scenario where you go 0.5 and then you have a little bit of wiggle room to either maintain strong rate hikes or tone it back a little bit, I think that would have been fine. Let's get another question here. Would you suggest automatic sell orders on the VXX if you're long 50% above the indicative value and that's where your strike price is, so you sell the order? No, I would probably recommend just trying to feel where the trade is going. Again, you're trying to get off that train before it, reaches the station, which is the announcement that they've resumed share creation. But if this thing goes berserk, you really wouldn't want to cut off your profit either. It's going to depend on the action. If it looks really aggressive and it looks like it's really taking hold and it's shooting upwards like that, like, for example, when we were looking at the VXX to VXX.IV, if it's going to be going super strong like it had been, it's actually easier to see on a intraday chart. So let's do a 5-day, 5-minute. This type of action, you wouldn't want to close your trade. If you saw too many days like this, like let's say it did go up 20, 30, 40% above, but you saw quite a few days that looked like this, then I would say that there's not a whole lot of possibility that it's going to really spike for you. But as long as you're seeing crazy movements, I would say this is a lotto ticket type of trade. So you don't want to try to take a lotto ticket trade and turn it into something safe. You're going to go for it, and if it doesn't work, and if it looks like it's too choppy and it's just not going to go there, then yeah, get out and take your profit when you can get it. That's what I would say. They cut down expected GDP growth for 2022. You don't say. Of course it's going to be lower. This is absurd. Yeah. That's SPY gap at likely heading there, 426. Huge reduction in expected GDP. Really? Big reduction, huh? It's funny how the whole priced in thing. I mean, doesn't everybody know that these numbers they're telling us are inflated? And then when they announce something, everybody's... No, I'm not saying you are surprised. You're not obviously surprised at all. Just there's traders who are... Like if it misses an estimate, even though we knew the estimate was silly to begin with, if it misses an estimate that's fake from the start, we somehow react to the miss in the estimate. No. Huge volume coming in, heading down. We will see. Like I said, I would suspect that tomorrow is going to be much more telling, right? So today, the market was actually up, I don't know how high. I saw it at one point. It was up 1.7. It might have been higher than that. But now it's still up 0.75. So let's say, for example, the market... Let me show you what I'm looking at. Let's say, for example, the market did end green today. We might see one of those, rallies into Thursday, Friday, and next Monday that makes this all go away. That's why I said you don't want to look at this and make any trade decisions based on that. And it's not just today. I'm basically saying as a longer-term trader's lesson, you don't want to ever try to gauge where the market is going off of 10 bars after a binary announcement. That's a really bad way to trade. It's high probability of whipsaw. You're going down, I'm going to sell. Oh, wait a second. It looks like it's recovering. I'm going to buy. Well, hold on a second. The market's actually still up 0.7% today. This isn't that bad. Okay, I'm going to buy back again, and then it dumps at the close. Wait till tomorrow. This is one of those things that I say it a lot with our options trading, but it fits here as well. Always wait for confirmation of your signals. Don't waste money opening yourself up to whipsaw when it's unnecessary. It's tempting for all of us to say, like, okay, I've seen enough. I've seen enough. It's going down. I don't know. Is it? Might be up 2% tomorrow. Overnight, the market thinks about it. They're like, you know what? 0.25 is kind of the Goldilocks range. Let's buy. Might be. You never know. Fed funds rate is also hotter than expected. Not good. Well, when we're this decoupled from reality and the Fed balance sheet is $9 trillion and rates are zero, and apparently during a strong economy, 12 years after the financial crisis, I don't know. I don't know what the Fed is thinking they even can do at this point. TD Ameritrade increased margin requirements on VXX positions. Interesting. I don't typically open. I'm guilty of not opening my TD Ameritrade and notifications. I should. I don't have any trades on. That's why I'm not opening them. But you should get in the habit. That's just a small side tip for anybody who's still watching. Make sure that your broker, whoever your broker is, they have the right address, email address, phone number. Make sure they have all that so that you're getting it in your primary email inbox. I can't tell you how many times people have told me something happened in my account and nobody told me, nobody notified me. Well, they probably did because it's the law and they can get in a lot of financial trouble if they don't. But it might have just gone to your junk folder. It might have gone to an old burner email that you used and you're thinking, well, I don't want the junk mail. If you're trading with a broker, you need to give them an avenue for them to contact you. So here I am saying that I don't check the notifications, but at least I see them every day. And I know that, oh, wow, I've got an option trade that it's got short strikes in the money. I might have got an assignment. I'll open all of them. So make sure you do that. Flat here due to other stuff related to trading. My standard for busy streaks. Yeah, just go flat in the portfolio so nothing really hurts you that bad, but you still got a little bit of skin in the game. I'm the same. I don't expect, I mean, anything can happen, but I don't expect large fluctuations in my portfolio. You know, like we're talking about just really nothing changes there. I'm somewhat neutral. I think I'm about a 0.45 beta factor to the S&P right now. So I'm slightly net long the market, but not a big deal. Thank you for being open and sharing your thoughts. You're welcome. Forward my stuff to your friends. I like being the person that people can get their questions answered because there's a lot of, you know, the volatility experts on Twitter. I mean, you can try to DM them, but you're probably not going to get any of your questions answered. So I kind of want to be that source where we can just hang out once a week and everybody can get their questions answered. Say hello to this little girl. Yeah, she's been good. I don't know why. I usually kick her out of the room, but yeah, she sits with me all day long when I'm working. I'm literally at this computer desk for 12 hours every day, and she is right there. It's funny, though, if I get up out of my chair, she'll immediately steal it. She knows that this is the second spot. The chair is the primary, so if I stand up and get a drink, when I come back, every single time she's sitting in my chair. Which volatility products are open to manipulation, like VXX, and which not? I guess UVXY is by design impossible to short squeeze. This should be the ABC before ever trading them. None of the volatility ETPs are open to what you would call manipulation because they all track underlying methodologies and they track very well. There's going to be certain periods where something could happen, like TVIX breaks in 2012, TVIX right before it was delisted in July of 2020, rings a bell. ZIV before it was delisted. Events, right? Recently, Barclays stops the share creation on VXX, but the vast majority of time, there is no manipulation whatsoever on these products. They track exactly how they should. NAV and the intraday indicative, they can get out of line temporarily, but they're very quickly brought back into line, and there is no manipulation. What bothers people is when they look at long-term charts of the VXX, for example, or maybe we'll even look at something even worse. Look at the UVXY, or I guess we could look at TVIX as well. But UVXY still trades. This is a 1.5 times leverage factor. When people look at this, they think it's broken. They think that, wow, what is wrong with this product? Why would the issuing bank launch a product that is absolutely going to go down long term? Why would they do that? They're stealing our money, aren't they? They're basically transferring wealth from all of us, you know, plebs, and then they're taking all the money for themselves. What is going on? It's broken. It's manipulated. Wall Street's out to scam us. I get it. I'm anti-Wall Street, anti-financial industry as well. But what you have to understand is there's nothing wrong with that picture. That picture is exactly what you would expect for an insurance product. The insurance on your car looks exactly like that chart does. The fire insurance on your house looks almost identical to that UVXY picture. This. Occasionally somebody breaks in and you take a little insurance policy. Sometimes you might have a little issue with something. More than likely, everything that acts as insurance is going to go down. It has to by very design. If UVXY didn't go down, the market itself would break. You need insurance products to decay. If they didn't, everybody would hold adequate hedging at all times and the market wouldn't function normally. So if you looked at a long-term chart of a constant rolling hedge on an SP put, for example, S&P 500 put option, it's going to look just like the UVXY. If you look at VIX calls, it's going to look just like the UVXY. It's such a stark thing in our face all the time. Like, look at a chart. This is unbelievable. There's nothing broken about it. It tracks its indicative value very, very closely, and it will obviously, minus a few bumps along the way, it's going to have those spikes. Sometimes fire insurance pays off. The majority of time it does not. And that leads people to think that these products are somehow manipulated. Some of them are designed, like the inverse products, to, for the most part, go up, or at least tread water, and you can have some nice runs with the shorts, but you got to really, really be careful about those spikes because Volpocalypse, termination, things like that, October 1987, that can happen. But for the most part, they are what they are. And SVXY, UVXY, VXX, VIXY, VXZ, VIXM, we could go on and on. They all function exactly how they should. There's almost no deviation from what we would expect. So I know sometimes it bothers people, especially when you look at a long-term chart. You think that this is just, you see it on Twitter all the time. VXX, worst structured product in the history of products. Is it really? Because that's kind of what insurance looks like. I'm pretty sure that's what my car insurance chart looks like. I've never really been in an accident. I've never, well, be careful. I'm not superstitious, but just in case. Don't want to say something that stupid. But yeah, that's kind of what it looks like. And why do I buy car insurance? Well, one, because the government forces me to, but also it is just a good idea to protect yourself against catastrophic losses because I can afford little premiums, but what I don't want is the occasional $20,000 hit. That's going to affect my budget. The regular $200 payments are not going to affect my budget. So my car insurance looks like a long-term UVXY as well. Let's check some of these. Okay. I don't know what this means. You've got the Goldfinger look. The only thing that Goldfinger, I mean, is that an old Bond villain? It sounds like it. I better not be disappointed when I Google what Goldfinger is. It's funny, I get some comments sometimes. I remember this one guy made a comment, just made me laugh. He said he didn't know that Timothy Oliphant made financial videos on YouTube. I thought that was really funny because apparently he thinks I look like that guy, that actor. I get other people thinking, wow, Matt Damon knows quite a bit about volatility products. That's funny. I don't think I look anything like those guys, but 25 should have priced in. Anything higher would have been much stronger reaction. Let's check the reaction. Let's see what's going on. See, so this is kind of what I'm saying is that, boy, this is hard to trade because it did look like down, but then it kind of looks like up, and the market is still green, and if it closes green, you never really know what's going to happen here. So I'd just let it go and check back later. Okay. I went on that whole long spiel, and apparently that's not what you were asking. Referring to products where they cannot be premium discount to NAV. Only products that always track what they are supposed to. No ifs, no occasionally, no exceptions. Well, all the volatility ETPs I think would qualify under that, but every single one of them is subject to life. Apparently something happened at Barclays. We don't know what, but that's not normal. So I think all of them would check this box, that there is no ifs, no occasional, no exceptions. They do track. But every single product can break. Every single product can be redeemed. I think the SPY could, I mean, I think probably if you read the prospectus, even that could be subject to these things. So I think they all check the box of no, there's no squeeze potential for any of these. They will always bounce back very quickly to their values. It's just how they're designed. Do you find that for the most part your YouTube comments are civil and ask intelligent questions? Yeah, 99%. I've had maybe a handful of negative comments. And typically when people make negative comments, I don't care. I mean, I don't mean to sound cold, but I don't care. People can say whatever they want. What's that old saying? Bombers get flack when they're over the target. If somebody's going to insult me and call me names and call me a fraud, well, it's not true. So why would that insult me? It's kind of silly to be offended by somebody insulting my work or anything. So, okay, say whatever you like about me. I know what I am and I know what I do. So I typically respond politely, and I try, if there's a question somewhere in their rant, I will answer it. And typically even that person will say, oh, okay, sorry, I just, I was just frustrated, or I was confused, or whatever. So no, basically zero. I always say I must have the settings wrong, because I'm not seeing any negative comments. You guys in the YouTube chat there, you get to see all of them. I only get to see the ones my software shows me, unfortunately. But are there any? Is there somebody screaming profanity at me right now? I never see it. So I suppose it's everybody's fear when they're going to do a live stream that this chat's just going to be full of people calling them a fraud. It wouldn't bother me. It's just things that aren't true don't tend to really impact me. So even if there was somebody screaming at me, I think I'd probably just ignore it. I just looked up Timothy Olyphant. Yeah. You see any of it, like it at all? I think none. I think when people say Matt Damon, no, but it's not horrible. I mean, everybody tries to match up a celebrity for some. Well, I guess it's because you don't know my Uncle Bob. You only know celebrities. So everybody sort of matches the celebrities. Timothy Olyphant. Okay. He's got way cooler hair than me. I watched a show he was in. I wish I had his hair. The halting of VXX shares seems to screw up IB's calculations of daily P&L. For me, it shows an unheard of daily loss while my NAV is actually up. Could you give an explanation? I'd wait for the end of day mark. Usually there's, not usually, but there can occasionally be massive differences. Because the bid-ask spread is going to widen so much, if they're marking your trade to not the midpoint, maybe they're marking it at something else, it can show you really crazy numbers. But maybe wait till the market closes, check back, see what it looks like. And if it doesn't bounce back, then in one day, then of course contact them. But I trade with IB as well. My long-term portfolio is with IB. So I always notice that it's a little off, especially in times like this. We've got the VXX doing pretty crazy stuff. I would suspect that the bid-ask spreads have been intentionally widened here. Market makers, can you imagine having this job to make a market when this is happening? So the only way to really protect themselves is to try to widen things out, slow things down. So I would imagine that the likelihood of getting bad mark prices is very high right now. But as long as you know that your trade isn't actually what they're showing, I think that's the most important. Pay close attention, understand your own trades. You can probably get a good idea of, where you're at. What is this? I'm interested in that, but there's a lot of crosstalk. Barclays institutions do not have conventional margin requirements. You mean those of the exchange? Possibly, but on the other hand, they can easily source liquidity everywhere. I don't want to jump in halfway if I'm missing this. Possible that Barclays was affected by the no, absolutely not. That I see where that's going. No, they're not getting their liquidity at the same places that we are. They're getting their liquidity. It doesn't matter about margin requirements and whatnot. Now, as far as this one, I suspect that's the problem, is that they're having a difficult time sourcing hedging at a price that they find acceptable. Of course, it's always price sensitive. If they pay enough, they'll get it. But something probably happened behind the scenes where they're having difficulty securing what they think will be a profitable trade, because they're in the business of making money too. And they're not going to lock in trades that guarantee losses. So I suspect that's what's happening. But no, margin requirements at brokers for us is not the same thing as margin requirements for Barclays or iPath or ProShares. Not the same thing. Oh, I hope you're not calling me Shooter McGavin. Shooter McGavin's from the Happy Gilmore movie. Awesome movie, by the way. Are you saying I look like Shooter McGavin? How do you use those MAs? MAs. What are MAs? How do you use those MAs? Don't know. Is Osachov a Ukrainian name? It's a Russian name, but close enough. My dad's side of the family is Russian, and my mom's side of the family is German, and I am fully Canadian. They are too. I mean, they were both born in Canada, but the name Osachov is Russian name. My great-grandparents are, all Russian speaking. And then my mom's side, I think it goes back a long way before you get somebody who was not speaking English. But yeah, Happy Gilmore, that was a great movie. Man, that was a good movie. All right, so thank you. That's the last one. Thank you. I don't want to look like Shooter McGavin at all. Please, give me Timothy Oliphant at least. Chart behind me, MA, moving averages. That's the VXX. Looks like about a 3-year chart, right? No, that behind me, that's the VXX to indicative value over 5 years, it looks like. So you can see it right here is the reverse split. So, okay. I don't use the moving averages at all. At all. They're just there, and I guess because they look cool. I got it. Looks like a 200 and a 50. Useless. TA. I don't want the comment section to blow up, but no thanks. Okay, guys. It's 2:30 for me in the morning, so I got to get some sleep. Let's see if this girl can come back and say hi. She's dead. She's totally dead. All right, so take your trades. Be cautious. Again, you don't have to trade this thing if you don't want to. Don't jump in and do anything silly. If you don't understand it or you think that, look, it looks fun, but I'm not going to put 10% of my portfolio on this thing, so it's not even really worth it at the end. That's kind of where I fall on this whole mess, is that if I wanted, I could take a 2 or 3% trade, but I mean, what's the point? So I probably won't. But if you do, good luck. Remember, you do not want to be long VXX when that announcement comes. Good luck staying ahead of that one.